Good afternoon. Welcome to the DoubleLine event. My name is Ron Riddell, president of DoubleLine Group. I think we got a great event in store for you today, and what a beautiful setting this is.
Yeah, I was hoping for a good view.
This is pretty nice. But before we get started, I'd like to thank a few people, Barbara Van Every and the Investor Services team. I want to thank them for putting this event on. There's a lot of work involved in getting this thing established, and I want to thank them. Also, DoubleLine representatives, we have a lot of them here today. After the event, there'll be a reception over here to my right, your left. And welcome to stick around and enjoy the festivities after. I have the pleasure of introducing our moderator, who is going to be introducing the two speakers today. Jeff Sherman is the Deputy CIO of DoubleLine. He serves as a lead manager in the multi-sector and derivatives-based investment strategies, member of DoubleLine's executive committee and the fixed income asset allocation committee. Many of you might have seen him and it can be heard regularly on his podcast, The Sherman Show, at Sherman Show Pod, where he interviews distinguished guests, giving listeners insight into DoubleLine's current views. In 2018, money management executive named Jeff Sherman as one of the top 10 fund managers to watch in their special yearly report. So without further ado, Mr. Jeff Sherman.
Well, thanks, Ron, and thanks, everybody, for coming today. Hopefully, we have a pretty exciting discussion that's going to take place. But first, we want to introduce the two speakers today. If you don't know Danielle DiMartino Booth, you're definitely missing out. She puts together great economic research. She's the CEO and head of intelligence at Quill Intelligence, LLC, her own firm. You may have also seen there's a book on the table that she wrote about her experience when she was at the Federal Reserve in the Dallas Federal Reserve. And so she was advisor to the president, and you may be familiar with him, who is Mr. Richard Fisher. So Danielle provides a lot of insight, too, on the Economic Forum, and I think you'll find some of her comments today very engaging. And why I know this is we had a podcast recording this morning, and her facial expressions, her screaming at me for words I used, I don't think will come through appropriately on the podcast, so maybe we'll get another view of that today. Right? So, and to her left and to my right is DoubleLine CEO, probably doesn't need much introduction, Jeffrey-Gundlach, Bond King, macro extraordinaire, and what was it, the 9th time you spoke at the Iverson conference yesterday?
9, yeah.
9 consecutive time. I think we call him the reigning champ there. So he's going for the new Jeopardy record, I think, too, after he retires here at DoubleLine. So that's not any time in the future, by the way. So with that, I want to start this off by just talking about the economic landscape before we get into Fed bashing and ECB bashing and all the stuff that we're all well known for. Let's talk about the economic data set. So here we are at the end. It's been about 4.5 months into the year, and the economic data hasn't changed materially, probably, over the last, let's say, 9 months or so. But markets have had a tough ride, right? We had a big drawdown in the fourth quarter. We came back with a very, very rapid rise in risk assets for the first 3 months of the year. It's kind of continued, maybe a little wobbly as of late. But Danielle, what do you make of this current environment? What are investors seeing today that was lost, let's say, in the fourth quarter, for instance?
Well, I think the most important thing that you have to focus on is liquidity, liquidity, liquidity. It's like location, location, location. So I'm not sure that any of us were anticipating the Chinese were going to deploy $868 billion plus in the space of 3 months into the markets, and that was a huge game changer. The Powell pivot just threw gasoline onto that fire. It allowed CFOs to go back to the business of buying back shares, which is all they want to do. And the combined stimulus of those two gave us, as Jeff just said, the fastest, most rapid, most violent rebound in the history of U.S. stock markets. So think about that. Markets rebounded more than they ever have. So we had seen across the board, we had seen every single employment metric, aside from wage inflation and the unemployment rate, bottom out in September. That includes initial jobless claims. And we've just now seen a complete and total round trip. We've seen a double bottom in initial jobless claims. They were exactly what they were in April as what they were in September. 217 on average, both months, we've seen a double bottom. We've seen the unemployment rate come back down to 3.6. Underneath the veneer of a lot of these great headlines, however, we've seen 9 straight months of layoffs increasing. We have seen, I mean, it's a good backdrop to declare another trade war and screen tariffs, because we've seen manufacturing come to a complete slowdown. We've seen port activity, automobile activity, rail activity, activity on the borders, you name it. We have seen a slowdown. We've seen a crash in big rig pricing. We've seen Cass freight index come down 4 months in a row. That is not an aberration. It is not a trend, it's a fact. So I think right now policymakers they're being prodded and pushed to keep the party going. And I'm not quite sure that they can make that happen. I think that's the big unknown. I don't know how much more panic buying you can induce in front of more threatened tariffs when you've got an inventory overhang to deal with.
Yeah, it's quite amazing to actually hear that it's a positive to slap tariffs on goods because you want to stoke that continued growth, right? Where you've seen the
absolutely.
dissipation,
We
right?
had Hurricane Harvey,
Yeah.
we had the tax bill, and then we had panic-induced tariff buying. We had 3 massive, I mean, remember, the US automobile industry was technically in recession in September 2017. And think of the triple whammy of stimulus that hit this economy subsequent to that point. And off we went to the races. But markets don't care. They don't care about what happened yesterday. All they want to know is, what are you going to do for me next? And somebody's whispering in Trump's ear that needs to be 100 basis points in QE yesterday.
Right. Also, C&I loans came out, and they're now crashing. They're at the lowest level they've been since basically in the Great Recession of 10 years ago. And you feel rather like you're living in the twilight zone when you look at what's coming out of the White House and the administration. I mean, last Friday was one of the most embarrassing interviews I think I've ever seen, when the vice president, in an interview with Eamon Jeffers at CNBC, said, "This economy is roaring." And in the next breath, it was, "And we should cut rates 100 basis points immediately and start QE."
Because that makes sense.
Yeah, it's like the twilight zone. So the thing that I've been focusing on, I mean, Sherman said that the data didn't really change much. I think the data got a little soft there in the fourth quarter, supporting the stock market down, and then started to rebound. It feels like it's getting a little softer now. One of the slides that I used at the Stone conference yesterday, which I don't think people fully appreciated because it went by pretty fast, is one of the indicators that we use is the Citibank 12-month, the year-over-year data change index. And it's a pretty good index to follow, because it basically says we'll take a very broad basket of indicators, including hard data and survey data, and we'll compare the one that's just released to its 12-month moving average. So if it comes out below the 12-month moving average, obviously the trend is not good. And that index is very highly correlated with changes in GDP on a year-over-year basis, except it has the excellent feature that it tends to lead a little bit. And it has a history of when it diverges, then typically GDP follows. So the year-over-year Citibank data change series has absolutely cratered since the beginning of 2018. It was incredibly high. You remember, as we entered 2018, it was a global, synchronized global boom narrative. It was actually sort of true at that moment. Most of these things were flashing pretty bright green. And then the global stock market peaked January 26th of 2018, and it's really never gotten globally anywhere close back to that again. The US hung on all the way until October 3rd. But really, I was given a hard time today by Scott Wapner on CNBC. And I don't mind that. He's sort of a friend of mine. But he kept saying, like, how can you call this anything but a roaring bull market? And I go, well, maybe because it hasn't gone anywhere in 15 months. The US market is lower. The Dow Jones never made it back above the October high. The one I care most about is the New York Stock Exchange Composite. It's the biggest one. It peaked with the global stock market January 26th. It didn't even go to a new high in October, and now it's put in recently another lower high, and now we have a little bit of a rollover. But one of the things that I've been really focused on, and I stopped talking about it for about 6 or 7 years, and I announced I was going to stop talking about it, was the national debt problem that got a lot of focus in 2011. You'll remember the downgrade of the United States by one of the rating agencies. What a joke that is. I mean, what they're doing is opining on the purchasing power of your monetized returned money. I mean, that's not their job. Their job is to opine on purchasing power of maturing bonds, because if you're going to downgrade the US based upon a dollar view, you should downgrade every single dollar-based investment and every single dollar-based bond. So, we have this situation where the debt has really gone off the radar screen. I knew it would, because the compounding curve took a little break there, and I said it would in 2012 and 2013. I said, I've got good news for you. While we're on the highway to hell, we are at a rest stop right now, and the situation will not really get worse until maybe 2019. Well, here we are. And it actually got worse already. When I predicted before the primaries started in 2016 that Donald Trump was going to win, when he was just an asterisk, what I also said is Donald Trump loves debt. And he's never paid back debt, I think, ever. And he's gone bankrupt like so many times, and he loves debt. So you can bet dollars to donuts that you're going to see an expansion of the deficit very similar in trajectory to what Ronald Reagan did. Because Ronald Reagan's slogan, believe it or not, was, let's make America great again. Look it up. Now, Trump dropped the let's. We're in more of an ADHD world, so we have to shorten things up.
Hashtag.
So see, right? So now now that's it. But last year, in the best reported GDP of recent years and nominal GDP above 5% for the first calendar year in a while, the national debt grew by $1.4 trillion, which happens to be more than 6% of GDP. So the national debt grew more in calendar 18 than nominal GDP. What that says, with the mathematics of GDP calculation, if the national debt had stayed stable and not risen, economic growth in 2018 would have been negative. Negative. We now have 123, and I think it rounds to 124 trillion dollars of unpaid liabilities in the United States. That's almost 600% of GDP. When we think about that, if we actually decided to fund those over a 60-year time period, so we're not doing it all at once, we're doing it very gradualistically, we would have to go and we would have to take 10% of our GDP in today's dollars and save it. Instead, we're borrowing 6%. So we'd have to have a switch from -6 to +10 for 60 years. That would be a depression for 60 years in terms of living standard, because you're having to save all this money. And obviously, that cannot happen. So one of the things I talked about yesterday was that interest rates, there's a really big dilemma here on interest rates, because the experience of the fourth quarter had a lot to do with China slowing down and then re-stimulating, but also had a lot to do with the market basically sending the message that no mas for the economy on interest rate increases, and certainly no mas on QT. Mm-hmm. Because isn't it interesting that when QT went to its maximum potential of 50 billion per month in October, the stock market peaked 3 days later. And then QT drove the market down into an obvious bear market, and then the fire truck showed up, and Powell went from, what we thought we had, which was disciplined, rational, pragmatic, and all of a sudden he turned into this, who knows? Like I made a joke, in our world today, there's all these crazy things. New York City has 31 accepted pronouns for gender. One of them is gender fluid. And I guess that means that you can change your mind on a short-term basis. Well, change your mind on a short-term basis, Jay Powell is policy fluid. He doesn't identify as a hawk or a dove. I mean, he might for a week, but then a couple weeks later, he identifies as the other side. And Once you go into policy fluidity, you're in the world where anything can happen on short notice, including the latest idea being promoted by some mainstream economists, which is let's just follow the ECB and the BOJ, and we can just borrow to infinity with interest rates at zero, which I think is true. I mean, I guess you can borrow to infinity if interest rates are at zero, but it creates what you've seen in Europe. I mean, how's the European banking system doing? We were just chatting before we came on the stage. Deutsche Bank stock, the all-time low is 7.81 on the close. I have excellent news for you. It is not at a new all-time low today with the global stock market being very weak. It says 7.84. And that's a really bad sign, because when there's something about the bank that has the nation's name on it going into single digits when it used to be up 9 times higher, there's something about that gets people alarmed. It was when Bank of America stock dropped into single digits that we started panicking with the off-balance sheet stuff that started to balloon up the Fed's balance sheet. And so I think that if interest rates were allowed to price, like soybeans are allowed to price on a commodity exchange, why doesn't the Fed determine the price of soybeans? Why don't they determine the price of any particular item? Well, they decide they're going to determine the price of money, and they have the mandate to do that, which is, well, money's really not fiat currency backed, but whatever, the short-term interest rate, the Fed funds rate. That's it. But now they've decided they're going to decide, or at least some central banks are deciding the price of mortgages. They're deciding mortgage money. They're deciding the price of the Treasury borrowing amount.
Corporate debt.
Corporate debt. If they stopped doing that, interest rates would rise. However, if interest rates start to rise, they might have to go to zero. So we're in this really weird world where almost anything can happen. I can argue for the 6% 10-year in 2021 that I talked about in 2016 when the 10-year was at 1.32. I could also argue for the 0% 10-year because of the manipulation. So really what you want to do, I think, is bet on this unstable situation finally devolving into one of the binary outcomes. And volatility on assets, both treasuries at the long end and equities, are basically, well, they're up today on equities and yesterday, but on Friday, they were at all-time lows. So the volatility is deemed to be non-existent because of the snapback and the ferocity of the snapback, because we've been living with almost no change in 30-year interest rates for years. I mean, the 10-year Treasury was basically where it is today 5 years ago. Exactly. Short rates are up 200 basis points. Even the 2 years up almost 200. But the long end has been pegged. So, where's this going to end? One of these binary outcomes, I think, has to happen. So I think this is the time to be betting pretty heavily. And it's on stocks, you're like 2 days late, like the VIX, the MOVE index, things like that, which is on the Treasury market. And one last thing on the economy. The first quarter GDP number looks really fishy because the deflator fell by a lot. Sherman, do you remember?
I think it was 1.4 on the deflator.
It went to 0.9.
0.9. Oh, I was looking at the headline.
I think before then it was 1.7. I think it dropped 80 basis points.
It dropped a fair amount.
Yeah, I think it was 80 basis points it dropped. Well, why did that happen? It's because the deflator works a little bit with a lag. So it's almost like a 3-month lag on the deflator. So for example, commodity prices that are in the first quarter deflator happen to be the ones that were prevailing in December. Well, we all know what happened in December, right? We had a bear market and everything. Commodities collapsed. Oil went from $70 to $40 from the span of September to December. And so that's what's in the first quarter deflator. However, if you checked your Bloomberg terminal lately, oil is over $60 a barrel. So it's up 50% since then, which rather strongly suggests that the deflator could go up very substantially for the second quarter and really show kind of a punky sort of real GDP number, absent other things improving.
Even so, business investment and consumption were both cut in half. in that particular report. It was driven by inventories, it was driven by state and local spending, it was driven by the decline in imports. I mean, there was a lot of math that went into that number, but not a lot of economic strength.
Yeah, it is always funny how that's reported, because when we're talking about the core PCE, like the number we just got, it's significantly higher, but they're always doing this lag variable analysis on it for the quarter data.
Yeah.
But it doesn't have the current quarter in it. It's still going into it. So.
Another twilight zone thing is when you get consumer borrowing that comes out with like consumer spending numbers. Consumer spending numbers will be strong, and it'll be because there's massive borrowing. And you see people applauding this, cheering it on, saying, this is great. I mean, it's so great that the consumer is so optimistic, because the only reason that they're borrowing so much money is clearly because they feel so good about things.
Biggest drawdown in the saving rate in 6 years.
It's like you meet an old college buddy, and you say, hey, Bill, how you doing? And he goes, I am crushing it. I am crushing it. I've got 100 LTV mortgage, and I got a second behind it. I got 5 credit cards, and they're all maxed out. And I just borrowed some money from my brother-in-law, and I brought this Breitling right here. How's this guy really doing? And he says, hey, Jeffrey, what's up with you? I don't know. I've got massive savings. I don't have any debt whatsoever. I guess I'm kind of sucking, you know? But which one is healthy?
Right.
You know, this idea that borrowing is a great thing because it shows that consumers are optimistic, it actually shows that they're falling behind.
But it's led by example with the government. And so the basic premise behind MMT, right, the modern monetary theory, which is a mouthful to say. I mean, that's why we keep the acronym. But I think what you look at there, it's predicated upon growth being greater than the interest rate that you pay, right? And they should be done either in both nominal or both real.
Well, there's all kinds of problems with this. There's time window problems. The borrowing cost is in the future, and the growth that you just measured was in the past.
Right.
How do you know what the growth is going to be for the next 10 years? When you borrow 10 years at 2.5%, you don't know growth is going to be 0 or 5. Yeah. It's like the old riddle. I like to tell the story. There's an old riddle that we thought was pretty clever when we were in first grade. It's about how old you have to be to think it's clever, but it still trips people up. And that is, show you how old this riddle is and how old I am, because it was when I was in first grade. These 3 travelers are traveling together, and they check into a hotel. And it's $30 for a room. This is how old the story is. And they don't have a lot of money. They decide they're going to bunk up, and they're going to sleep in the same room. So they each give the guy $10. And the guy, as they leave, he feels bad because he kind of overcharged them. It's really only $25 for the room. He feels bad, so he grabs the bellman, and he says, here's 5 ones. Give it back to the guys. I don't want to overcharge them. The bellhop says to himself, hey, I can't divide 5 3 ways with these 5 $1 bills, so I should get a little vig myself. So I'll give each of them $1, and I'll keep 2. And the way the riddle goes is, okay, so now each man has paid $9 for the room, right? That's $27. The bellhop has 2. That's only $29. There's $1 gone missing. How can that happen? Well, that's because you don't add the bellhop's $2. You subtract it, right? That's where the money is. There's 3 in the till, 9 these guys, right?
Yep.
There's 25 in the till. These guys each have 3, and the hop has 2. That's it. Yet that's when people do this. The modern monetary theory, as long as you're borrowing at a rate that's lower than your growth, you know, you can borrow as much as you want. Well, that's comparing totally different time series.
And on top of that, there's one huge assumption that you refuted earlier. It also assumes that you have deficit neutrality, because you tack on at 6% or 7%, whatever rate we're borrowing as a percentage of GDP, that also has to be overcome.
Right. Well, and in the last 2 recessions, we had outsized growth in the growth in national debt, which I always use growth in national debt. You know, another bad sign is when they talk about the on-balance sheet deficit, which in fiscal 18 was under $800 billion, but the real deficit was over 1.2. The net growth in national debt was over 1.2 trillion. So they're way underreporting that way how much it goes up.
Yeah. So Danielle, when you think about your experience at the Fed and thinking about the task at hand with Mr. Powell and his fluidity of thinking about things, what is the Fed's objective these days? Is it to promote the stock market? Is it to actually be a catalyst for growth? What do you think that the objective is? Not what's stated, but actually what it is.
I think right now the Fed has its eye, I think Jay Powell has his eye right now on the credit markets. I think that he understands, after we were talking about this earlier today, when General Electric's bonds were downgraded by Moody's on Halloween, and within 14 days, the junk bond market shut down. And then we had 41 record days that followed with no issuance at all. I think that that's what scared him. Spreads gapped out, outflows were beyond anything he could comprehend. And remember, this is a post-Dodd-Frank world. Broker-dealer balance sheets, they don't have the cushion that they used to have. They don't hold the inventory that they used to. There's no capacity in the financial system for a run on bond ETFs. It cannot happen. These aren't options. This is not an option for Jay Powell.
For those, I just want to clarify, because she's absolutely right. But some people that aren't intimate with the bond market don't know is in the old days, pre-financial crisis, what would happen is when retail would sell or investors would get scared and pull money, dealers would balloon up their balance sheets.
Yeah.
It was actually a great way for them to make money because they were basically a liquidity provider, and bond prices were down, and they were able to buy them. And then as things improved, they were able to offload them.
Right.
They can't do that anymore.
No.
So this shock absorber on spreads and on demand disappearing was eliminated.
And making matters worse, we've had so much of the inventory flow into the private equity world. That's where a lot of the paper lives. And you tell me if you think you're going to get a kind bid-ask spread when you've got a fire sale and you absolutely need to liquidate. And so listening to bond traders, in November and December, some of these bonds were trading by appointment only. And, against a backdrop of $244 some odd trillion of debt worldwide that's grown, there's been no beautiful deleveraging.
But also in the U.S. high yield market in December, there was not a deal printed.
Right, for 41 days.
Right, the origination.
So, getting back to
non-existent.
home, it was extremely problematic. And when you think about the catalyst, which was GE's BBB bond, that's an investment grade bond that traded overnight into junk territory. This is a man who, in October 2012, said, it appears that we are blowing a duration bubble across the entire credit spectrum. Those are his words, not mine. He has a private equity background. He founded the Industrials Group when he was at the Carlyle. He understands banks. He speaks to CEOs. He understands funding costs. What happened in the stock market is not what scared Jay Powell. What happened in the credit market, however, that really was game over for him, and he had no choice but to come running back in, because there's not a person in this room, including you, who can say what the end game looks like if we start to see a daisy chain of liquidation in the corporate bond market in the United States today. There's simply too much junk out there, and the rating agencies have been just as egregiously derelict in their duty as they were leading up to the subprime crisis. It's just much quieter and much more sophisticated because these are investment grade bonds. And it's polite speak, and you're not talking about tranches and equity and who owns what and who's going to get caught with a bag. It's just gigantic companies with huge, you said it on CNBC today, there's been a tripling of the size of this debt market.
Yeah, the subprime problem, though, the securitized mortgage problem, when it hit, the securitized mortgage market between Alt-A, prime, and subprime was $2 trillion. But it was wickedly misrated. A big piece of it was horrifically misrated. I mean, it was stuff that was going to zero, basically. But the AAAs, some of the AAAs, I guess, with the fullness of hindsight, maybe sort of deserved an investment grade rating because some of them made it all the way. But the problem was $2 trillion, and parts of it were really, really severe. Now, I don't think the rating problem in the corporate bond market is as bad. I don't think they're as egregiously overrated. But the corporate bond market is $8 trillion. Mm-hmm. And the BBB corporate bond market is bigger than the junk bond market. And per a Morgan Stanley research report several months ago, fully 45% of the entire investment grade bond market, not just the BBBs, although most of them do live in BBB land that fall into this analysis, fully 45% of them, based upon leverage ratio, should be rated junk right now. Right now. Not if trends continue, right now. Now, leverage ratio is not the only metric. but it seems to me that leverage ratio is highly important when it comes to determining creditworthiness. And so you could see in the next economic downturn that there's no hope but to downgrade these companies. Because the reason they're not being downgraded, again, leverage ratio isn't the only thing, but also these rating agencies have been known to listen to reassuring statements with sympathetic ears about actions that will be taken at some future date to correct these leverage ratios. But if there's a downturn in the economy, you can't fix those leverage ratios.
It's interesting, Jeffrey, because a friend of mine who will go unnamed, who was in high yield in one of the big three, quit it because the pressure was just too much. It was there were too many companies that they were being pressured to keep above that BBB line when everything on their spreadsheet said they belong below the line. And management saying, no, they're gonna clean up their act.
Yeah, right.
We need fees from underwriting or for rating the deals too. Don't forget.
Life in parts of the junk bond market is pretty interesting. I've never really lived as a trader in the junk bond market, but I certainly have a lot of people work for me that do, and I like to check in with them on when weird things happen. So there are some bonds that they were trying to float, and this was probably in October. They were trying to float, and like nobody wanted them at the spreads they were trying to get for them. And so there's pressure applied from the bond underwriters. Come on, we will let you in on those deals 2 years ago, so you got to take one for the team. And they actually do. They actually go, okay, if I'm going to get back in the game when times are good, and I can get good allocations when the market's strong and attractive, then it's okay for me. I mean, don't record this for your clients, right? I mean, because obviously DoubleLine would never, ever do anything like that. But people do. And it's kind of shocking. I'll give you an example that's a metaphor, that you might be a little bit more, it's a little more simplistic. There was a company that went IPO that was called Blue Apron.
Oh, gosh.
And every single person knew that it was a dog. Every single person. I mean, it dropped like, I don't know if it was 40% or 70%, whatever it was, the first couple of weeks. And because everybody knew it was going to happen. And I remember one of my junk bond guys saying, that's more egregious, but that's what happens. Because if you want to get the hot IPO, then every now and then we've got to all cover our nose and take down the Blue Aprons of the world. And that happens from time to time in the corporate bond market until such time as it can't happen again. I was telling Danielle's story about the CDO market back in the day. And we had done some CDOs in like 2004, and we had done them with Merrill Lynch. And we couldn't get any done. They wouldn't do them anymore with us come 2006. And so we had a dinner. They happened to be in town to talk to other managers, but some of our guys, I think, had some friendships, so we went to dinner. And I wanted to go because I wanted to understand what was happening. And they said, well, we don't want to do any CDOs with you. I said, well, why? Well, first of all, if we go with a first-time manager, we can dictate the fee. They'll do it for almost anything we say. But much better than that, they never say no. They have to do what we say because we're putting them in business. So you guys say no. And because you say no, I mean, you're not a good partner. We want basically a toxic dumping ground for this stuff. And so I was very alarmed. And I went and I had lunch with a guy who I knew, who was named Dow Kim. He was the number 2 guy in all of Merrill Lynch. And he had told me a year earlier that his biggest mistake was under-leveraging. This is in 2006, if you can believe it. Under-leveraging. And they only had 25 billion of leverage, and they should have 50 billion of leverage on their balance sheet. And I was in New York, and I went to him and I said, I've got to talk to you about your CDO team. I think it's, the overseer of this group. You've really got to know what's going on here. And we were having lunch, and he didn't bat an eye. He was completely unperturbed and blasé about it. And I was like, I don't get this. Until just a few days later, he announced his resignation after he got his $180 million bonus and decamped back to Korea.
Convenient.
So when that type of stuff happens, like how many Blue Aprons are there? I don't know. But how many, when you get into that environment again with the jamming of bonds, into pocket accounts. It's the type of thing that's kind of the dark underbelly of the underwriting process.
I would add a positive, which Jeffrey, I know you know that I don't do those very often after spending an hour with me today, but there was a ray of light in the corporate bond market in the beginning of this year, in the first quarter, and that was that CCC pricing did not come back in. So there was at least some sign of rationale among investors that they didn't drink the full glass of Kool-Aid, because they never did bring in the bonds that are closest to defaulting in terms of making them be part of the rally. And I thought that that was at least a sign of rationale as we watched investment grade and high yield bond spreads come crashing back down in the first quarter.
So you'd mentioned liquidity and and Mr. Powell being concerned about essentially the credit market seizing up. So you know, he was concerned, but he still said automatic pilot. You know, on the balance sheet, that's part of liquidity.
And that was the most curious thing I think he's ever done, because there were already stories on the wires, and it's.
He was very dismissive that it was even a problem up until that point as well.
It was. So Richard and I both left. I mean, he asked me to stay on at the Fed, and I'm like, I'm not a bureaucrat, let me go. But he asked me for 4 more years. I gave him for 4 more years. So we met shortly after at a football game in Austin, and he pulled me aside and he said, I want you to pay attention to one person and only one person on that committee. So this is August of 2015. He said, Jay Powell. He's the only rational person. He has been going toe-to-toe with the New York Fed. He's got his eye on reinvestment. He wants to shrink the balance sheet. He's been fighting right alongside me all this time. And he's your guy. Just follow him. Just listen to him. And I'm like, 12 months later, I'm like, listen to what? He never says a word. He was the quietest person on that committee. And he was also the most rational. And he went down kicking and screaming because he truly had in his mind, I will not waver from QT. It will be like watching paint dry. I will get to my goal from 2012, 2013, and I will get to my 3% on the Fed funds rate. I'm getting there. I'm not going to fight the next recession with half the ammunition of every other recession. And yet here he is.
Yeah, well, he did have a good streak going. It was his 8 consecutive press conferences, or his 8 consecutive speeches where he tanked the market. He got January and March right? Yep. That, according to the stock market. And then, all of a sudden, last month, right? All of a sudden, or I'm sorry, last week, 2 weeks ago, week and a half ago. I'll get it right at one point. But ultimately, at that last meeting, all of a sudden, he didn't give the market what it wanted, right? And he's back to his losing streak again.
When Jay goes back to being Jay, it ain't pretty. Mm-hmm. So if Trump is tweeting out the day before a 100 basis point cut and QE tomorrow because I want what other countries have, give it to me, and screaming for a pacifier in social media, the old Jay is going to come back out of his shell. And he had a 6.5 minute statement. He broke his record. His former, I need to get out more. His former record was 43 minutes. He broke it. He had a 41-minute press conference. He wanted to get in and out of there, no matter how hard reporters pressed him on Rich Clarida's fairy tale insurance rate cut, which is all the markets were clamoring for. He kept pushing back, and markets showed him how they felt about his reticence. So he went, that was just him being refluid.
I thought the most disturbing thing about that press conference had nothing to do with markets. And that was one reporter, I think they were trying to get at, Stephen Moore said something that was kind of silly about wage growth, gender-based wage growth. It was really like, you wonder where he's coming from. But Stephen Moore said, it's really a problem. Maybe, I think he used the word problem. He probably didn't really mean problem, but that's what came out of his mouth. He said, it's a problem that women's wage growth has been good, at 3 point something for whatever period of time. But it's a problem because men's wage growth is only 1 point something. And someone says, do you agree with Stephen Moore to Jay Powell? And Jay paused for what felt like 10 seconds. It was probably 5. Because you could see the gears in his mouth turning. I don't want to say anything.
Oh, yeah.
I don't want to say anything. I don't want to give like how can I answer this and not, and he said, I think that women and men's pay for same work should by and large be the same. And I thought, the guy is trying so hard to say, that's one of the fattest pitches of all time. You ask me that, I would say, you know what? Hallelujah! I mean, we all know about this gender gap, and it's been there, and all this 70 cents on the dollar stuff. I mean, that's just the narrative. There's all kinds of problems with that narrative, but let's just accept it, okay? So that's there. So at least maybe there's signs we're making progress. Women are finally starting to get progress towards that pay gap. Next question. It's so easy.
But he's been ingrained to think like somebody who works inside the Federal Reserve, and the Federal Reserve is focused on one demographic, males between the ages of 25 and 54 in their prime earning years. And as far as people inside the Fed are concerned, that is highly problematic. And that's the difference between even the 2012 and the 2013 FOMC transcripts show the slow evolution of Jay Powell's thinking. When he and Jeremy Stein, I'm sure you remember Jeremy Stein, when they were both rookies on the FOMC, they were these two mavericks. Charlie Plosser, Richard Fisher.
Yeah.
I mean, there were like 4 people that actually spoke English on that committee at the same time. And it was so much fun to hear him come back. He'd come back from the FOMC, and I pissed off this person and this. It was fun. But there was almost a decent minority of rational thinkers. But Jay Powell has been ingrained to think the way central bankers think, and that takes away from his ability to be a real person.
Well, the market beatdown that he got in December was really traumatic, I think. And he knows, he kind of got a get out of jail free card maybe by his actions, particularly in March when he kind of went uber dovishly crazy.
Well, don't forget about when he was sitting on stage with Janet and Ben and said QE.
That was the turning point, though. That's where he really. I think that was the pivot more than anything.
That
it's
was
like
more than anything else.
Yeah, I think
when
they
he was
came
on
in
stage.
because he
That
got
was
his learning card. His 12 months of
you consider
experience. That was his
QE?
card-carrying
Yes, I
member
would.
to be a Fed chairperson
At
at
which
that
point I went. I mean, my Twitter feed went.
Yeah, right.
The minute he said he would consider QE.
Well, and so let's think about what he just did. And now I recall it was actually 10 days ago. Okay. When he did his speech, there was this focus on everything is transitory. It's transient, the inflation.
Transient.
And it reminded me, I think I went to your desk, Jeffrey, I said, this is just like Yellen. He has totally adopted her speech.
He is Janet.
Right? And what does that mean? So rewind the clock from 12 months ago. Like, who is this guy? Is it that he's been indoctrinated into the club now? Is he still a free thinker? Is he being bullied by markets? Is there any insight on what we can think about when we lead into the next meeting in about 4.5 weeks?
I think it's a combination of things, and I think that it's also dangerous to discount the influence of Rich Clarida joining the board, right? He's vice chairman, and he definitely has Powell's ear, and if you don't just study some of the things that he has said, he's more dovish than Draghi. But he understands.
That's hard. That's hard to do. That's really hard to do. Yeah.
I mean, as we were talking about earlier today, there was the tequila crisis. There was Orange County ahead of the 95 insurance rate cut. There was an actual calamity. There was the long-term capital management ahead of the 1998 insurance rate cut. Right now, we theoretically have a roaring economy. So why are we talking about an insurance rate cut?
Is it Deutsche Bank?
I think the reason we're talking about an insurance rate cut is that the yield on 2-, 3-, and 5-year treasuries are exactly the same, and was going into the December disaster.
2s, 5s inverted in December.
Yeah, a little. I mean, I call them the same. It was kind of a rounding item, but you're right. I mean, literally, you're absolutely right. Here the stock market's roaring back, and first it's collapsing, then it's roaring back, and the bond market is basically and the Fed says we're going to raise rates 2 times next year and a couple times the year after, and the bond market's laughing in their face. It's like, you're not going to raise rates for 5 more years, man.
Yep.
5 years. And that just sort of means that probably maybe you're going to have to cut, and you saw that the odds of a rate cut before the most recent press conference got up to 80% for a rate cut in December. And I think they've settled back down. I haven't looked
After
at the,
today,
We're in the mid-50s, I think. coming
Yeah,
in this morning.
I haven't seen the WERP, which is what it's called, since Friday. It was at exactly 50-50, basically. I think it was slightly under 50, but call it 50-50. So a bit down to a coin flip. So
So maybe you can expand on that, Jeffrey. So we look at the stock market. When I said the economic data largely hadn't changed, it's a little bit softer. Risk markets, though, are back to their levels where they were, let's say, going into the fourth quarter. And I say risk market, I'm talking stocks, credit, high yield specifically.
yeah, it's almost all the way back.
Investment grade's probably tighter today on spread basis.
I'm not sure.
Yeah,
we're about to have a record May.
right. So
issuance.
why are rates being stubborn at these levels and not participating in that? And there's a big disconnect between risk markets and, let's say, U.S. rates. What do you make of that?
Well, the rate market has been, as I said earlier, extraordinarily stable. And I think it kind of sees through these vicissitudes. I mean, one thing that I found very interesting is as the stock market was falling during the October through early December period, what was interesting is that there was no bond rally to speak of, particularly at the long end. There wasn't any. I mean, things were getting worse and worse. Oil was collapsing. Mm-hmm. Stocks were collapsing, and there was no bond rally. And I think that basically the bond market is very worried in its heart of hearts that the next recession should have interest rates going higher. And yet at the same time, it's kind of like what I said earlier, they're worried that they're going to get manipulated to zero. So they kind of sit there kind of in the midpoint of these two really
Extremes there.
binary outcomes. It's sort of, we should either be at 0 or 6,
Yeah.
and we're at 3.
While Europe
Right
stays,
in the
like, on a relative basis, while Europe stays in a meltdown mode with negative rates.
Right, and the yield curve, the message the yield curve is sending is broadly misunderstood. I hear a lot of people that want to think positively about the global economy saying, well, I know the yield curve inverted 2s to 5s a little bit, and it's now still completely flat. But that doesn't really mean anything this time, which I've heard every time. This doesn't really matter this time because the shape of the yield curve is really being distorted by QE around the world, which is like the biggest nonsense you're ever going to hear, because if QE was causing foreigners to love our 10-year, they should doubly love our 2-year, because the extra pickup is bigger on the 2-year than it is on the 10-year. If anything, QE is steepening our yield curve. Mm-hmm. Just like in 2006, the rap was Chinese buying is distorting the yield curve. That was exactly the same nonsense because the Chinese were buying 5 years in it. They weren't buying 30 years. So that meant that they were steepening out the yield curve. And I also believe that at this interest rate level, it gets harder and harder to really invert the curve. We may not really get a real inversion because rates are so low. I mean, back in the day when you had an inversion, the 2-year Treasury was at 8.50 and the 10-year Treasury 30-year was at 8. Now, I'm not going to call you an idiot for buying an 8% 10-year or 30-year, even though you could buy an 8.50 2-year if you're in a 4% and falling inflation environment. Don't you want to lock in that real rate of return? Well, what's your real rate of return now? Well, we think that the CPI, and you pick your favorite inflation measure, and none of them are perfect by a mile, but we believe that based upon $60 oil, which is pretty much where we're hovering, that we should see the CPI go to 2.3 for the year. And this model is simplistic, but shockingly accurate.
Headline.
Headline. So there's 2.3, and you basically have a Treasury market that yields 2.3. So your real yield is 0, and don't forget that if you're a taxpayer, you have to pay tax on that yield as well. So it's actually a negative after-tax yield. So why should you buy the 10-year if it yields the same as the 2-year, and both of them have a negative rate of return? And you should be a little bit worried about the potential for inflation, as a desired outcome. I mean, I don't know how crazy these free money people really are, or how much traction they're going to get. But they do want to just give money away. Andrew Yang being the most upfront about it, it's his #1 issue. He wants to give every American, including Jeff Bezos, $1,000 a month if you're over 18. And he's concluded that $1,000 a month is perfect. It's like Goldilocks. It's not too hot, not too cold. And the reason is he thinks it will not take away the work incentive. It's not enough to take away the work incentive, but it's enough to help. And he's quoting some sort of bizarre psychological research that says that people will be healthier and relationships will be stronger between, your relationships with your family will be stronger because of this $1,000 a month. And I go, Jay, that's an interesting, weird thought experiment in psychology, but what he's saying is that the healthiest and happiest Americans are those on welfare, by extending that logic, which I really strongly doubt. And I don't think, his idea was if you give somebody $1,000, they'll buy organic vegetables and they'll be healthier instead of the chemical stuff they're buying now. I got a feeling they're going to buy more beer.
And it won't bring the meritocracy back, and it won't bring back the ability to break out as an American, and it won't fix the inequality divide. It won't do anything.
Right. We've been giving money, free money to people for years. And I try to be really open-minded, and on this issue, I really am somewhat sympathetic to the logic of the millennials. The logic is, look, why is it okay to explode our national debt when it's corporate tax cuts and increased military spending and giving stuff to old geezers? Why is that okay?
On Wall Street.
Yeah. And it's not okay for us to get free tuition. Now, there's some symmetry to that logic. It's not illogical. It's just two wrongs don't make a right, is the issue. So I can understand. I mean, these are people who, you tell them about, the American dream and this idea of an arc of increased prosperity in the United States. They don't believe you. They've experienced 2 severe recessions. They've experienced middle-aged wages going nowhere. Nowhere. They don't see any. I saw an escrow article, and it's years ago now. It was probably in the year 2010, and I'm sure it's gotten worse than it was then, that government spending at the federal level for people over 65 was 7 times the amount of government spending for people, and I don't remember if it was 18 or 25 or 21. It was long enough ago. But for that younger group, this is a recipe for disaster. You've got to invest in the future, not in the past. But so the seeds of this have been being sowed for a long time. And you wonder what's going to happen in the next recession when you have the deficit, increasing. Before the last two, when it went up by 8% in the Great Recession and 6%, the national debt to GDP increased by that much amount on an annualized basis. Before then, it was 4%. So you could say it's a trend, 4, 6, 8, 10, or you could say 6 and 8 are anomalies, it's going to be 4 again. It doesn't matter which one you pick. You're going to go to an increase in the national debt next recession based upon the 4 number of 11.5, and based upon the 8 number, right, of 14.5. So what are you going to do with that one? I think you're either going to do MMT or you're going to do UBT, Universal Basic Income, UBI. And that could be inflationary, that UBI stuff. Because I've been saying this, some of you have heard me say this before. I can get inflation, it's 423, I can get inflation by 5 o'clock. We announce that the Treasury Department is going to wire every single American $1 billion. $1 billion. I mean, this room would clear so fast. You'd be in line at the Ferrari dealer so fast, but unfortunately, it's already 5 miles long unless they raise the price.
But that's taking MMT to its extremes.
Yes, it is.
But and so I would add, back up a little bit.
I'm being hyperbolic.
I would add that there were some of us inside the Fed at the time, and we were noticing that Blackstone was tippy-toeing into buying single-family homes and renting them out, and there were several staff papers that were written at the time that were saying this might end badly. The millennials might need to procreate at some point, and if you invite price-agnostic buyers into these markets, that should be cleared by fire sale for foreclosures, not by deep-pocketed investors coming in and propping up the prices. it might end badly. And by the way, another reason not necessarily to go to the zero bound is you're going to lock seniors into their homes to where they never feel like if interest rates rise, they'll never want a higher mortgage rate, so you might also have a mobility crisis on your hand. And these were discussions that went on at the Fed, and where are we 10 years later? Both renting and buying are more expensive than they've ever been, and because mom and pop, the ATM machine that was attached to their home was shut off, kids had no choice but to go out and take student loans out. So right now you've got millennials that are saddled not just with student loans, but they can't afford to ever leave home or they can't afford to ever buy and far. And both of these are outgrowths of policies that at the time we knew we were creating.
It was comical when they basically rounded up the CEOs of the major banks a little while ago, several weeks ago, and they were kind of giving them a lot of grief about climate change, as if like it's their fault, and grief about a lot of stuff. And I think it was Maxine Waters asked Jamie Dimon, what are you going to do about all this evil student loan debt you've created?
I wish I could have recorded that.
People are drowning in student loan debt, and you evil JP Morganers are profiting off the backs of our young people. And Jamie Dimon says, we haven't made a student loan in 10 years. All the student loans go directly from the government.
Yeah.
You're the one that has saddled the young people with your idiotic guarantee because there's no risk. So,
and that is a blanket assumption of a full, I mean, if it's 22, who cares if it's $23.5 trillion of debt? I mean, I think that is something that will be bipartisan by election day, is full-born forgiveness of all student loans.
well, certainly some candidates have come up with one. These things can be kind of tricky to implement. They sound just sort of better as hypothetical ideas. Like, do I get a check? I want my student loan debt eradicated, right? I mean, I paid it back. Because I paid it back means that I'm screwed? What about the MD that took out $200,000 of student loan and just paid it back?
Yep.
I mean, what about that? And there's this, and the other thing that I think is problematic about some of the programs that have been announced is this idea that the more money you make, you fully get rid of the student loan debt if you make $100,000 or less, and then if you get up to $249,000 even, you get a little bit. But what people don't understand is a lot of the student loan debt is taken on by people who do lots of schooling, like lawyers and MDs and MBAs. And what you're really doing by eliminating their debt is taking Joe Sixpack, who never went to college, taking his tax money and giving it to wealthy people. It's exactly non-progressive. It's a regressive tax, and these are the same people that are railing against the 1% and want a wealth tax and all this other stuff, just pandering to the electorate, which is obviously nothing new. But if they really think it through, that program isn't exactly really important or in sync with their other tax philosophies.
So Danielle, you had written in your book too about these Fed policies, how they've created this monster too. They've created this debt burden, this leveraging, zombie companies and the like. With the next recession, if indeed it ever comes, I heard Jay back in September say that this expansion could go indefinitely.
It's a long time.
It's a long time. Yellen said that she would see, in our lifetimes, we'd never see another recession. I always thought it was her lifetime when she said it, but that said.
That was financial crisis, let's just be.
Okay, no, it was a financial instability, right, exactly. So when you think about what happens in the next recession, you said they have half the ammo because typically the rate cuts have been 400 to 500 basis points during a recession, or at least leading into it. What do they do this time? Do we have to go negative? What happens? Do we respect the zero lower bound that the markets haven't respected, nor the ECB? What does it look like in your lens, or from your lens?
Well, I mean, what people forget is that going into the financial crisis, we didn't have a price of money problem. Price of money wasn't even on the radar screen. It was part of something called the Bernanke doctrine. His models suggested to him that he had to get to the zero bound before he could launch quantitative easing. So therefore, he went there. And there were a few people saying, you got a liquidity issue on your hands. The credit markets have frozen across, you name it, duration-wise, whether you're talking about overnight paper or government borrowing in other governments. And so there were a lot of us who fought to stop at 2%. And that was not popular. And obviously on December the 14th, 2008, we went to the zero bound. And the question of negative interest rates in the United States, we do not have the same structure, banking structure, money market funds. You're talking about multi-trillion-dollar industries that would disappear overnight, to say nothing of the entire state of Illinois. I mean, it would be like one of those, it would be vanished, just zoom, right off the map because of its pension. So I think that there are reasons to stop at the zero bound, to not go there. I think the European Central Bank has taught us that if you go there, you might not ever come back. They will go into recession with negative interest rates. I made a speech in Brussels to that effect last year, and they laughed at me. And I said, you're never getting out of negative interest rates. Ask a German life insurance company how they're doing.
Yeah, I met with a Swiss life insurance guy, and he said it's really depressing.
Oh, yeah.
He said it's really depressing because we understand, as executives of this insurance company, that our definition of success is to extend the time till bankruptcy. That's the definition of success. Bankruptcy is certain. We're trying to get there as slowly as possible.
But writ large, given some of our funding issues, because we have underfunded our pensions because of the separation of state and federal. So, if you look at Europe, those are national type of systems. Those are national safety nets. And we don't have a law in existence for states to declare bankruptcy in the United States. So you start to run into some very, very thorny issues very quickly if you veer into negative interest rate territory, which brings you to saturating the mortgage bonds. We were talking about that earlier today. In the end, people think that Bernanke decided that he wanted to all of a sudden be hawkish and taper. Not in his lifetime. But mechanistically, QE had become problematic. We were buying net 80% of issuance in the mortgage market. There were some QSIPs of treasuries where we owned 40% of outstanding. We were running out of things to buy, and we were shoving every last natural buyer out of the market such that if we were to ever exit, imagine that they wouldn't be there to take our place. So if we don't have negative interest rates, then we do have an act of Congress to allow them to maybe allow Illinois to stay on the map and buy municipal bonds of bankrupt states. Yeah. And that's usually the answer that's thrown out there. And next along the line would be corporate bonds, and next along the line would be equities, of course.
Right. So it's what Europe is doing today, what the Japanese have been doing for decades.
It's like a combo platter. Right. Just put it all together.
The problem is that it goes hand in glove with worsening wealth inequality.
Of course. That's why MMT will work.
You're getting this rubber band stretch. You can stretch it further, but it's going to snap. People eventually just can't take it anymore.
And I think that as heretical as it sounds, the reason in a downturn, in a true recession, that MMT could be adopted is because there will be a rationale, as opposed to, riots in the streets. But there will be a rationale, that there will be a groundswell of humanity, if there's not a socialist in the White House, that says you cannot keep bailing out Wall Street. If you can print money, which clearly you can, every penny of securities put on the Federal Reserve's balance sheet that cannot be unwound is not effective. It is de facto. It is true debt monetization. So Bernanke has demonstrated that you can monetize the debt of the United States. So given that that's your starting point, MMT by definition works when applied to anything fiscal in nature. And that's why it could work.
So next recession, we see QE via MMT print the money and distribute it out fiscally, and all of a sudden turn around and repurchase the treasury assets that are used to issue.
Bernanke made a speech in Tokyo where he said you need to issue, now it hurts my brain to say it, you need to issue zero coupon perpetual bonds and take that money and give it away. And then it all works. As you said earlier today, You just create the security, and
Right.
then it's endless.
Right.
Then
It's-
your hyperbole is not hyperbole.
Right. I remember the pricing equation for perpetual bond. It's very simple, right? It is the coupon, right? The interest rate divided by the price. 0. That's what it's worth, right? But you can do an infinite amount.
Sounds like 0 to me, yeah.
Right? So what do? Right? You create this debt instrument. I mean, it is essentially printing money. In a world that people talk
And
about being...
everybody in Beijing says, yay, we get reserve currency status, let's have a party. However you say that in Mandarin.
We'll ask your kids, right? They're studying it, right? As you told me
All
earlier.
4 of my
Yeah.
children are studying Mandarin, just in case, rather have them in the State Department decoding than, anyways,
Yeah.
we can talk offline.
Yeah. That's not a Texas hedge, that's a Chinese hedge.
That's a Chinese
Yeah.
hedge. It's a
Okay.
Chinese hedge all day long. I speak Spanish, but they're all learning Mandarin.
Yeah.
And it's just a just-in-case scenario because, Jay Powell himself said a few days ago, we talked about it today, he brought up the example of Australia. Australia's, 29 years at this point, right?
Yeah.
I mean, can anybody give him the detail that they never went to the zero bound, they're at 1.5%, they never had QE, and they happen to have this great big benefactor called China
Yeah.
that buys all of its natural resources.
Right.
So, I mean, when you have all that going for you, why ever go into recession? Why bother? They're going to expand for as long as China expands. And right now they're having troubles, which is reflective of Mother China also having troubles. But it doesn't have anything to do with QE or taking rates to the zero bound. The Reserve Bank of Australia was much, much more judicious and prudent in how they approach monetary policy, and that was a good thing.
Yeah. So
It's strange how people seem to be fond of the belief that China can grow forever at 7%, 8%, 6%, whatever number you want to believe in. Because it's so strange to me. If they really believe that and they attribute that to the autocratic sort of economic system or leadership of the economy, why don't we do it? Why don't we just throw all this stuff out the window and grow at 7% forever using an autocratic economy? I mean, I'm not even being facetious. If you really believe that, let's do it.
Yeah, well,
I
we
mean,
haven't
if
figured that
anything,
part out yet.
If anything, you need to reflect back on the record stimulus deployed in China in the first quarter and how little they've gotten in return for that. We've not seen a continuation. We've not seen an acceleration of the improvement in Chinese economic data. We've simply seen a stabilization. That's called the law of diminishing returns.
Well, that's a very positive, upbeat note, finally.
Oh, well,
Yeah.
let's talk about something happy.
Okay, so each of you give
So
me
about
one
the
happy
Bills.
point. So Buffalo Bills, maybe we'll start with you, Jeffrey.
I'm looking forward to the future.
Yeah.
For real this time,
Right.
because the Bills, the salary cap in the NFL is $177 million per team. And last season, that team has been so mismanaged that last season they paid $53 million to players not on the team, which means that they were
Dead
working
weight.
with $124 million
Call it dead cap weight, right? Is that what
dead
it's
cap.
called?
Yeah, dead cap. So, that's ridiculous.
Yeah, it's
And
almost
they
a
have-
third.
Now they have none.
Yeah.
So now they've got all kinds of money to spend. So I'm optimistic.
All right.
We're talking Super Bowl.
All right.
So
Yeah. Hey, everybody's undefeated at the beginning of the season, right?
Right.
Yeah. Danielle, uplifting story.
I actually have two.
Great.
I'm all about bringing meritocracy back
Yeah.
to the country, and I think we've seen a lot of great examples throughout the country of the resurgence of vocational training. We've seen charter schools, we've seen magnet schools. I'm of the opinion that if we educate our children instead of telling them to sit there, we'll give you income if you sit there and do nothing, because that's productive for the economy. No. I'm of the opinion that if we educate our children and find new ways to educate them and to get around all of the bureaucracy that's torn apart our public education system, that then we can have a real honest-to-God future that's built from the ground up.
Oh, I totally agree. I was reading a book about a guy named John Albright, who was one of the greatest industrialists of the turn from the 19th to 20th century, but he left virtually no footprint at all. The guy he was totally behind the scenes. But very interesting guy. He owned more electricity, the distribution of electricity, the biggest steel plant, massive national bank. All this was in Western New York. The point, though, I bring this up, is he had an engineering degree from RPI, Rensselaer Polytechnic Institute, and he got it in the mid-1800s. An engineering degree meant something, probably still does, but I'll tell you how hard it was. 80% of the engineering class that he was in flunked out. 80%. And he said the other 20% were mental wrecks by the time they got out of it. It was that hard. Just to put that in context, that's the dropout rate from the most difficult military elite unit training program in the United States called the Navy SEALs. 80% failure rate. That's how hard it was to get out with a degree in engineering from RPI. Now what do you have to do? I don't know about RPI, maybe they stuck to their principles. There's plenty of schools where you basically can take coloring 101. I mean, there are coloring books, you know that, at some college. There are. Because when you get triggered by some microaggression, I'm not kidding.
I thought it was puppies.
They have those too. They have security. They have what do they call them? Security dog? No, it's comfort dog.
Comfort
dogs.
Security or
whatever it is.
I know they had them all. They were all over the East Coast after the election.
My niece got into Dartmouth early decision, which I'm very happy about. And when we took her to view the school, yes, there were these comfort dogs, whatever they're called. They were in the classroom buildings.
Life in liberal arts colleges is tough.
Yeah. So I think we need to expect more out of people. And I think people feel better if you expect more out of them. I think people feel better if they're self-actualized rather than sitting on the couch getting an extra six-pack with $1,000 a month.
But Jeffrey, tell me, what is the escape rate from the typical public school?
You escape, what's that mean, escape
That
rate?
means you're actually going to get out of school, you're going to be literate, you're going to be ready for college and ready to go on.
Oh, I don't.
That's probably closer to your 20%.
I think it's pretty low. Yeah.
And that's we need to flip that. We do. But I had a second optimistic whatever, and that is that the Longhorns have had a rebuilding decade, and it's over. Our coach is a member of Mensa, and last year we started our comeback, and just y'all tune in, okay?
Yeah.
Go Horns.
Hook 'em.
Hook 'em.
Yeah,
They're
okay.
tough to beat Alabama.
Yeah, I think you guys should help rebrand something. I think that we should rebrand MMT as the modern meritocracy theory.
Yes, I love it.
How about that?
I'm going to write about that.
Run with it. You can have it. So
Got it.
Before we go to the crowd with questions, I know there's questions out there. I want to do one thing that we do in our podcast each time, and I know this caused you a little PTSD last time, Danielle. But we like to do something we call Sherman Says, and it actually makes sense now because I'm the one asking the questions, But what we like to do is put out a phrase or a topic, and hopefully, unlike my co-host Sam Lau, who's given up on asking people for one-word answers, we're going to target the one-word answer. I know, Jeffrey, you always adhere to the rules, so it'll be a little challenging, but it'll be a little fun. And then we'll open up for questions. Does that work for everybody? So let's start with you, Jeffrey. Tariffs.
Going higher.
Powell. That's for you, Daniel. Powell.
Weak.
Jeffrey. Bernie.
He can raise money.
Yeah. There's something to be said of that. A lot of people can't raise money. To you, Daniel. Biden.
Has been.
Grope and Joe.
Jeffrey. Taxes.
Going higher.
Yeah. Danielle.
On me, anyway.
Yeah. Inflation.
Underreported.
Brexit. For you.
I'm going to do a little longer answer. Funny cartoon where it was Brexit, and there was this hallway of doors that said Brexit, 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 Brexit. It never ends.
Yeah, and Theresa May was walking through it. That's,
Yeah. I mean,
it's on our
it's
Twitter
never gonna
somewhere
happen.
if you want to look at it. I
It's
found
never
it
gonna
numerous. Yeah. So ECB.
Screwed.
That's a technical term, right?
Sorry.
Yeah. Okay. Yeah.
I'm doing the Pavlov thing.
Right.
Sorry.
Yeah. Yellen.
Short.
The market.
Yeah. The Bernanke.
Delusional.
You're just very flattering of your former colleague. Jeffrey, 2020.
More than 2 funded candidates.
Okay. Germany.
Electric vehicles.
Ah, combustion engine's gone, huh? Something that Mr. Lau asked me today that I was stumped on, and you'll see if you listen to the podcast that I think Danielle called me a sociopath. So be careful with your answer. Your guilty pleasure.
Saturday New York Times crossword puzzle.
So I don't think that's sociopathic. Okay. You can tune in to hear what I said. All right, China. China. That's how Mr. Trump says it. China.
Eye on the prize.
Jeffrey, inside the yield curve.
What was that guy's name? I actually did a panel with him once. There was co-authors. What's his name? Remember? It was the guy that did the writing book, too. Anyway, it's worth reading.
I expected that. Game of Thrones.
Need to record it.
All right. And last, nickname.
Shermanator.
It's mine, not yours.
I've never had a nickname in my life.
I'll take the
Isn't that
Shermanator.
weird?
Danielle, nickname.
Danny boy.
Danny boy. All right.
I've never had a nickname.
Never had a nickname.
Never.
That was my sister when she was being brutal.
Yeah. Eh. All right, so with that, we're going to conclude the Sherman Says. Hopefully you found it a little entertaining to lighten up the mood here. We'll open up to a few questions if people have them. I'm sure there are many. You shot your hand up first, so you get to go first. Melissa's going to walk around, and Patrice, they have mics, so maybe we can queue up the next question.
Feel free to take the book.
Feel free to take Danielle's book, ask her to sign it, take a picture with her, whatever you'd like, on the way out.
How many copies have you sold?
About 30,000.
It's pretty good for that type of topic.
Yeah.
It's not dry.
Yeah, but it's so funny because Trump thinks that he's trying to position things that if the economy rolls over before the election, he's going to blame it on Powell for over-tightening. That's a really bad calculation because I'd love to know what percentage of the population knows that the Federal Reserve exists. Right? I mean,
Yeah.
I bet it's under 30.
Yeah. Please.
Okay. Well, first, thank you so much. This is fantastic for all of us. Jeffrey, just to kind of bring you back from where you started, what's the catalyst that's going to freeze the credit markets? Is there a wall of maturity that we need to be looking at? Rates are still low. Some will say it doesn't really matter. Is it mostly contained to industrials, some energy, some miners? What type of spillover effect?
I just think it's real simple that the corporate bond market will really have problems when you see negative GDP. That's where it's basically the old Buffett thing of when the tide goes out, you can see who's swimming naked. And based upon what we talked about earlier, it's kind of a nude beach out there.
And remember that
Yeah.
if companies are forced to pay attention to their balance sheets, regardless of the reason, there's no more buybacks.
Yeah.
Just remember that.
Yeah. The problem with nude
Asterisk.
beaches, it's not what you visualize, right?
No.
It's typically the people you don't want to see.
Oh yeah, no,
Yeah.
for sure.
Yeah. Do we have more questions? In the front? Melissa, there's someone in the back.
First of all, thank you for making Jim Grant sound like Santa Claus. I didn't think that was possible, but you've mentioned four, I think, I count them, potential debt problem scenarios. One of the things we like to say is that market cycles don't die of old age. They are like rock and roll drummers. They die of their excesses and accumulation of excesses. And it's usually
Hey. I'm just a rock and roll drummer.
It's not just drummers either. Yeah.
wild rock and roll drummers.
Yeah.
So you mentioned the European banking system and finances over in Europe. The quote from, I believe, one of the Swiss insurance companies. You had U.S. corporate bonds, which you just mentioned again, potential for student loans, and then finally U.S. municipal finance. So those are probably the four areas of excess. What do you think is the catalyst? Which of those is going to go first?
I think the municipal problems are underappreciated. The state and local public pension systems are 50% funded. That's it, on average. But that'll probably not be the first one to go. I don't think that's the first one to go. I would think the big first one to go will be the European banking system.
They're the most stretched.
Another question in the back?
I feel like the movie Old School, where Will Ferrell has to debate James Carville. No, I'm kidding. Jeffrey, so you're saying that rates are being manipulated by the Fed to be too low, and that the prescription would be to have higher rates. You know, it strikes me that maybe that seems strange. I mean, in a way, like PIMCO says, we're in the new neutral, that there are valid reasons for the long rate to be lower for longer due to demographics, due to low investment and the like. And so, you know, there are more benign reasons, I guess, for rates to be low on the long end, and that, in fact, higher rates could be exactly what sends us into recession.
Sure.
In a low inflationary environment. And
Sure.
so that's what I guess I'm a little confused by why that the prescription would be higher rates, other than that there are bubbles, and that is the only thing that could erase those bubbles.
I'm not sure I'm saying the prescription is higher rates. I'm just making an analysis that says, based upon the supply of bonds that's coming between the corporations, that if they continue on their path, and they have to roll over a lot of maturities in the next couple of years, and the entitlement programs, what they're doing and how those compounding curves work, and on a bipartisan belief that we should spend a few $1 trillion on infrastructure, et cetera, I think it's a supply problem. And the Fed has not bought any bonds, really, for the past 3-year period or 4-year period. Foreigners, net, have not bought any of our Treasury bonds for the past 3 or 4-year period. The buyers have been domestic. And I just think that I don't see how those demographics are so great for low rates. I mean, I think the demographics, you're looking at the buying side. I'm looking at the entitlement side and thinking about just how big the bond issuance would be if the Fed doesn't come to the party. And I think that leads to higher rates. And I think it's very fascinating that with all that's gone on since, say, June of last year, with market stocks up, then way down, then back up, and fears of recession being quite acute in December, and then going away, and now sort of creeping back. This whole time period, the 30-year Treasury yield versus the 5-year Treasury yield has been rising. Not rapidly, but not imperceptibly either. And I think that that's a telltale that there is a paucity of interest a paucity of demand at these interest rate levels for 30-year Treasury bonds, and it's going to get worse when you get more and more bonds. That's, in essence, that's the essence of my point of view.
I think we have time for one more question. And while we look around, I cheated and looked it up. It's Marty Leibowitz, I think, was the answer.
It's Marty Leibowitz.
Yeah.
The other guy's Sidney Homer. That's funny.
Homer's the history of interest rates, right?
I think Sidney Homer was a co-writer. No, who's the guy that did that? It's so funny that the guy.
Oh, you're right. Homer's on there, too.
Yeah.
I should know better than to argue with you. Do we have any other questions? Okay. Yep.
Thank you for having us. Very much appreciated.
Talk a little more into the mic.
Sorry.
Yeah.
Question about the dollar and where you see it going in light of
The dollar?
Dollar.
Yeah, one of the things I've been best on in my career is the currency movement, dollar versus others. I was 100% dollar denominated in everything we did at DoubleLine, from the day we opened the doors 10 years ago, which was very near the bottom in the dollar, till December 2015 into January 2017. The dollar did nothing but go up over that period, and we turned negative on the dollar full on January of 2017. I think that there's a high historical correlation between weakness in the dollar and growth in the combined trade and fiscal deficits. It's a very strong correlation, and both of those appear to be on the wrong track. I also notice that the dollar moves in prolonged and relatively persistent trends that tend to last about 6 or 8 years. So if we topped in the dollar, if I'm right on that, and we haven't gone back above 100 since we broke below it on the dollar index, the Dixie, right? So if the peak in the Dixie was somewhere between those dates, let's just call it June of 2016, throw on like 6 or 8 years, let's call it 7, pick one in the middle. We were talking about 2023, I think. 2024 maybe is sort of like where the dollar might bottom out. And that's remarkably interesting with another aspect of our fiscal problems, which is the interest on existing treasury debt as a percentage of GDP, which has been stable for several years at a very comfortable level of 1.25% versus some previously more elevated levels. And a lot of people go like, well, that's weird, 1.25. What about all this debt you're talking about? How come the interest expense isn't going up? How come, Fed's raised rates 9 times. How come that isn't filtering through? Well, it takes time. The 10-year bonds that were issued at 150 in 2016, they're still at 150. They're not going up, so it takes time. But the interest paid on the treasury debt as a percent of GDP is no longer stable. It's starting to rise. And the CBO, not the most pessimistic of forecasters, because they assume no recession ever. They believe in Jay Powell, is that what he said indefinitely? Yeah. They say that around that same time period, maybe a little later, maybe 2027, that it will have reached 3% of GDP with no recession and with interest rates relatively tame. So when you think about that, that's pretty bad. That's 1.75% gouged out of GDP as a base case, and it's going to rise from there. And I can see that as being interesting, how it seems to kind of interconnect with the dollar long-term cycle. So I think the dollar's going down. I think it's fascinating that emerging market equities have performed so well in the fourth quarter relativistically, because the dollar did not go down. And usually when you have a big sell-off in US equities, there's an old phrase that the US sneezes and emerging markets catch a cold. Usually emerging markets are higher beta on the downside, and they underperform by a lot when the US goes down 20% plus, which is what happened. But emerging markets went down less than the United States in the fourth quarter, which I think is, with the dollar not even weakening, which I think is a harbinger of things to come. And I think it's discounting the fact that investors are starting to realize that perhaps the dollar does go down. And with our fiscal situation, if we didn't have the luxury of being the global reserve currency, the dollar would be so much weaker, and our interest rates would be so much higher. And we're kind of getting more into an isolationist mode, potentially. Certainly Trump has moved us somewhat in that direction. And if we're isolationist, we're not really going to spend all this money to protect the entirety of the world's shipping lanes, which is what keeps us the global reserve currency. Right. Is we are protecting all of the global shipping lanes, with the United States paying for it. If we stop doing that, then somebody else starts to get to play in the game that might be China.
Building islands.
So that would be any type of movement towards any weakening of the global reserve currency status or strengthening of some competitor would be devastating for the value of the dollar. And you could see that could tie into a return inflation and higher interest rate narrative pretty quickly.
Okay, with that, I want to thank everybody for attending today. Danielle DiMartino Booth, Jeffrey Gundlach. And as Ron Riddell had mentioned, after that uplifting discussion, there's always cocktails in the next room. So thanks for coming.
All right, thank you.